coming week is going to be about jobs, both top down and bottom up. From a macroeconomic perspective, the key feature will be the latest unemployment, employment and wage growth numbers in the UK. They will cover the 3 months to May and are due out on Tuesday the 16th of July. Remember that in April, unemployment was just 3.8%, the lowest level since late 1974. Employment was 76.1%, the highest figure since records began in the early 1970s. And wages grew by 3.4% year on year excluding bonuses and 3.1% including them, roughly 10-year highs on both counts. On Wednesday the 17th, we'll then get the latest UK inflation figures. In May, inflation, as measured by the Consumer Price Index or CPI, landed smack bang on the Bank of England's 2% target. That means that wages are growing faster than the cost of living, a good thing for consumers and possibly consumer spending, or if not spending, then at least the savings rate. Now this chart here shows wage growth, including and excluding bonuses, against CPI inflation. It does seem as if low unemployment and a tight labour market are finally driving wages higher. This chart, which I saw at a seminar hosted by Capital Economics, is interesting as it suggests there could be yet further upward pressure on pay. It shows year-on-year wage growth against a survey from the Bank of England called the Agent's Summary of Business Conditions. This particular data point looks at how many firms say they're having recruitment difficulties. And the harder it is to find the staff you want, you might think that the more you'd have to pay for the good ones you want. We shall see. It is a trend that could be good for consumers, bad for company profit margins, and a source of concern for the Bank of England, which is talking about cutting interest rates depending upon how Brexit plays out, even when this sort of data for wages would normally have the old lady of Threadneedle Street tightening monetary policy and not loosening it. Company-wise, we have a number of trading statements due out just ahead of the imminent torrent of first half and full year results releases that will sweep over us all in the week beginning 22 July. In this coming week, it might be worth keeping an eye on the following updates or results statements. Mining giant Rio Tinto on Monday the 15th of July. Another miner, BHP Billiton, as well as Burberry on the 16th. Severn Trent and TalkTalk on the 17th. And SSE, Thomas Cook, EasyJet and Sports Direct on Thursday the 18th. But for me, sticking with that jobs theme, the stock most likely to cause a big fuss in the week ahead is recruitment specialist Hays. The FTSE 250 member is due to report a fourth quarter trading update on Tuesday the 16th of July. The actual full year results are due out sometime in late August. By the time these Q4 numbers will have come out, we'll have already had updates from fellow recruiters Robert Walters and Page Group in the week before, although do note that those three do have different exposures in terms of geography and also industry mix. Hays shares, well, they've actually not done terribly much over the past year, as we can see from this graphic. I guess perhaps that reflects concerns over economic growth both here in the UK and in Hays global markets, of which more in a moment. With its quarterly updates, Hays offers fee figures only, or fee growth figures, and it does so in two ways. The first is by region. Hays breaks its fees down into 4 areas: Australia and New Zealand, which was 17% of the total in Q3, Germany, 27%, UK and Ireland, 23%, and finally rest of the world, which chipped in the final third of fee income. This chart shows the trend on a like-for-like constant currency growth basis over the past 3 years, which means we start with a quarter that came directly after the EU referendum vote in summer 2016. As you can see, the UK and Ireland segment has lagged the others by some distance for some time after that ballot. But in the last quarter to the end of March, the UK and Ireland came in with 3% growth, no different from the quarter before. That matched Australia and New Zealand, which slowed down a lot, although the rest of the world and Germany did better, though again, Germany showed a marked deceleration from the double-digit percentage growth that had been the trend for quite some time. Hays also breaks down its fee growth between permanent and temporary hires. Now, I would guess that the more confident employers are, the more likely they are to take on full-time staff, while they may favour temps if the outlook's a little bit less certain. The good news, therefore, is that fees from full-time hires have been growing much more quickly on a like-for-like basis, although the gap has begun to close. The overall rate of fee growth in the third quarter, by the way, was 6% year-on-year across the group, the slowest increase in 9 quarters on a like-for-like basis, going back to the fourth quarter of 2016. So remember to check out how the final period looks compared to that. Hays ended the third quarter with £30 million of net cash, so keep an eye on that trend. And also, just in case the company does talk about profits, which it normally doesn't do at this stage, analysts are expecting pre-tax income for the full year of £245 million against £239 million a year ago, with a 7% improvement again to £261 million expected for the new financial year that's just begun. Thank you for watching, and I look forward to seeing you next time.